I'm Aaron Spybrook. I'm a senior at Western and I'm majoring in finance and economics. Well, aside from everything on the CFA side, I think it was a great lesson in teamwork and learning to overcome challenges because a lot of this was outside of what we have learned here, and we had to go above and beyond that as a team and go into areas that we were unfamiliar with. I think the biggest challenge was trying to do what a CFA does without having the training that a CFA has. And I think we learned a lot about what it takes to do this job, and I think in the future it's going to help us a lot in our career paths. Well, I sure hope so, because if it's any more difficult than that, I think it's going to be tough for us. But yeah, I think we got a good idea of exactly what it is they do, and hopefully in the future we'll be able to apply those skills. I think that I definitely learned being a financial analyst is something that takes a lot of work, and I know now what it takes to do it, so I think I've learned at least that to advance in this profession, it takes a lot of time and effort.
We are the Western Michigan CFA Research Challenge team. I'm Thiago.
I'm Alex.
I'm Aaron.
I'm Xiaowei.
First off, I want to give off a little bit of the background. Kellogg is a company that started off in Battle Creek, Michigan. They manufacture over 18 different countries, and they actually sell or market them in 180 different countries. The company is divided into 7 business segments. There's morning foods and Kashi, U.S. snacks, U.S. specialty, North America and others, Europe, Latin America, and Pacific, or Asia Pacific. A little bit of the industry overview. They are in the processed packaged good breakfast industry, and there's a lot of competition. Some of their major competition is General Mills, Roll Corp Holdings, and Cereal Partners Worldwide. Between the 4 companies, they account for 65% of the entire market, and then Kellogg along accounts for 50% of all that. Their market share: Kellogg is the leading company in the global breakfast cereal market, and they account for 34.3% of the entire market share. Although General Mills accounts for a significant amount, they're only about a third of what Kellogg actually accounts for themselves. In the market distribution, they usually are found in supermarkets or hypermarkets such as Walmart, Costco, and Carrefour, and the leading distributor in the global breakfast cereal markets with 76.9%. And the second highest independent retailer is only with about 10.3%.
All right, I'm going to talk about investment summary. Kellogg's mission is to provide consumers with safety, healthy, good quality food. And Kellogg possessed the largest market share among top cereal makers in 2012. And due to the financial problem in Europe, Kellogg suffered a huge loss in 2012. On to the financial issue in Europe. European sales fell 13% in the first quarter and 13.4% in the second quarter in 2012. And Kellogg lost money in European market because the foreign currency impact and integration costs associated with the Pringles acquisition, increase in commodity costs, competition, and economic condition in Europe also impact on its sales. The competitive advantage, because the advantage built on Kellogg's strong base of global brand, excellent leadership, and sustainable growth. Its outstanding research and development team it allows the company to innovate new products better than its opponents. Kellogg's strategy are to provide more health and wellness-related food, offer other forms of cereals such as cereal bars, increase the U.S. and frozen food business growth speed, and promote new brands to key growth market, and also innovate new products. Kellogg's has pretty strong management team with with a large group of experienced and knowledgeable leaders. All right. Genetically modified free cereals are not easy to produce. Companies are hard to acquire GMO-free ingredients because the producers are limited by simple supply chain logistics, which makes the acquisition of ingredients expensive and difficult. So once the Kellogg starts selling the GMO-free cereals, the price might be higher than the regular cereals. All right, Project K. Kellogg is planning to cut 7% of global workforce, meaning it will cut 2,170 jobs over the next 4 years. This move will allow companies to save $1 billion, and it should be able to reach 425 to 425 millions annual run rate by 2018. In December last year, Kellogg's shut down its Australian snacks plant, expanded the Thailand cereal snacks plant, and also Kellogg announced that it will be completing construction on Australia Pringles manufacturing facility in Malaysia by mid-2015 to increase the growth in Asia-Pacific region. All right, let's move on to the valuation.
So for the valuation, because Kellogg's is an international consumer staple and they have good financial strength with a P2 short-term rating from Moody's as well as a Baa1 long-term rating that they've held since 2001 when after the acquisition of Keebler, we decided to use relative valuation techniques. Using an economic analysis of their sales in comparison with the US population, we did a regression and we came up with a 0.88 R squared and a low significance number showing good correlation between the two variables with 27-year analysis. But because of the paradigm shift in advertising, we decided to use a 15-year regression analysis since electronic advertising has caused a lot of Kellogg sales come from advertising, and since electronic advertising has increased their awareness, we decided that 15 years would be more indicative of what their actual sales would be next year. So here's the graph of the 27-year analysis, and as you can see, the trend line fits pretty well. Doing the 15-year analysis, of course, there are fewer observations, but we do get a higher R squared and still good significance in T-stat. And looking at the trend line here, we can see that it goes through a lot more points and looks a lot better for a prediction. So using that, we come up with this equation. Our population estimate for 2014 was 317 million. Plugging that in, we get a sales number of 15.126 billion for 2014. We also wanted to correct for anything that might affect the sales besides just the US population alone. So in order to do that, we took a compounded annual growth rate for their sales over the last 27 years, and we came up to 6.26%. We then multiplied the sales estimate of 2013 by 1 plus the growth rate to come out to an estimate of $16.142 billion in sales. Taking the average of those two numbers, we come to a final sales estimate of $15.634 billion in sales for Kellogg's in 2014. Next, we divided that by the number of shares outstanding as of July 2013, which was 362,440,126 to get a sales per share of 43.14. We then took an average PSR for the last 6 years, and it came out to 148. Then just multiplying through here, we got 148 equals the price divided by the sales per shares, and we come up to a sales price to sales share of $63.85.
Okay, continuing with the relative valuation techniques, this table here will point out what Kellogg, General Mills, and Nestle is trading at. So going back to 2009, we can see Kellogg's steadily increasing. They're trading at 15.5 earnings, going back to 2009, taking a 5-year average, while General Mills and Nestle are trading at 15.7 and 17.7 respectively. So just from this table alone, we can see that compared to the direct competitors, they're trading at a cheaper multiple. And comparing Kellogg to the industry and also the sector, respectively, Kellogg's at 15.5 earnings, while the industry 23.2 and the sector's at 23.97. And also, I'd like to point out over here that this is we made our own calculation for the 5-year EPS, and we came up with a percentage of 4.07%. So continuing with the relative valuation techniques, this slide points out the price to cash flow. Again, going back 5 years, we can see that Kellogg's steadily increasing, but they're moving at a snail's pace. There isn't much growth here, but still compared to General Mills and Nestle, they're trading at a lower multiple. So using the PE multiples and the price to cash flow models, we took our 5-year average, multiplied it by the current value per share, and this is a direct source from Value Line for the 2013 EPS. And we multiplied that by 1 plus the growth rate, which is also a source from Value Line. We come up with an intrinsic value of 61.32 for the PE multiple and 60.74 for the price to cash flow multiple. Taking the average of our 3 valuation techniques, we come up with an intrinsic value of $61.97. We really like this price. Despite the slow growth with Kellogg, we believe that the initiatives to cut costs, specifically in their supply chain and logistics department, and also their initiatives to expand in the emerging markets, we do see some room to grow for Kellogg. So especially with the recent pullback too, with Kellogg trading at around $58, $59, we think it's a good time to get into it. So at this time we recommend either to hold or to buy.
So a couple questions on your analysis. First, your regression. What exactly was the point of that?
Well, when we went to Kellogg's and heard the CFO speak, he said that the economic factors they look at when determining, trying to forecast is U.S. population growth and GDP. We decided to go with population growth in the United States because using GDP, there's a two-way causality between the variables, so it makes it a little bit harder. Since Kellogg sales are part of the United States GDP, it makes it a little bit harder to show. Even though there was a strong linkage between the two variables, we felt that using the U.S. population to try to predict sales was going to be better. I actually was the one who did that, and because I'm double majoring in finance and economics, I chose, when looking at it economically, we don't try to predict a stock price, but we do try to predict what the sales are going to be. And so using that number, we plug it into the price to sales to try to come up with something that would be a little bit closer to what they would be doing next year.
So based on this regression analysis, what is the relationship to U.S. population growth? Because if you're telling me that their sales are going to grow with population growth, then I'm not very impressed. If you're telling me there's some factor in population growth that's going to drive a faster growth in sales, that's what I'm really.
I think the issue is when you reach the level that Kellogg's has here, we're looking and we're saying that the cereal market's not going to grow much more than it is. I mean, and that's the thing. It's going to grow with the population. A lot of older consumers generally eat their cereal, according to the CFO. So I don't think there's a lot you could do besides just look at, well, how is the population itself growing, and then say that's actually what's going to drive the growth, besides, of course, their international sales. At the markets they're trying to break into where they're having some issues right now.
It's a multinational company, so why is the analysis against the U.S. population?
Well, because first of all, in the other markets right now, they're not doing as well. As Shaway pointed out, they lost in the European market due to many factors, and so we feel like their strong strength here is in the United States. That's where their core customer group is, and that's where they're going to get most of their sales from.
What's the breakdown of international to domestic sales right now?
I think it was 80% for domestic sales and 20% outside of the U.S. Total split between Latin, Asia Pacific, and European markets.
And you pick General Mills and Nestle as comparable companies. They both have dominant shelf space power in supermarkets.
Yeah.
That's why they were picked as.
Yeah. We believe that within the industry, those are their biggest competitors. General Mills is cereals, but also snacks as well. So we thought that would be a good comparison to show.
Any concern with the debt they're having because of the acquisitions they're taking on?
I don't think so. I think their ratings still stayed strong. In 2001, they took on $4.6 billion in debt to get Keebler. Since then, they dropped to a Baa1. Since then, they came a little bit up, and then after acquiring Pringles, they're back down to a Baa1. As of right now, I know Moody's is looking at it again. As of right now, I would say they're still financially strong, and I don't think that Pringles is necessarily a concern as they continue to integrate it. Once again, as Xiaowei said, part of the cost issues in Europe and part of the loss in Europe was the integration of the Pringles acquisition. So I think as that moves forward, that's going to be a good moneymaker for them, just like Keebler was. And I think, looking at their sales numbers, you go, after that, their growth was pretty stagnant, then a little bit of negative growth, then they acquired Keebler, 24% growth, 10% growth, then it kind of drops, tapers off again, back to stagnant, negative growth again, then they acquire Pringles, then we start to see some jumps again. So, like I said, they've kind of topped out there, so I think acquisitions might be the best way to go if they want to break into other markets and try to make money elsewhere.
So your sales growth showed that it was compound annual growth rate of 6.27%. Your regression was versus population, which 6.2% is way ahead of U.S. population growth. That might be 1 or 2% a year of that. So the question I have is, it seems as though most of their growth is driven by acquisitions, at least over the last decade or so.
Right.
What does their acquisition pipeline look like, and is there something there that's going to drive growth in the future?
As of right now, not that we are seeing. Obviously they're scaling back a lot with Project K, and with the acquisition of Pringles right now, I don't think they're in any position to be making another acquisition anytime in the near future, at least. I think right now they need to worry about paying off the long-term debt that they got from acquiring Pringles, as I was saying earlier, and then, maybe in the future perhaps there's something else there, but they're putting so much into trying to break into the Asia-Pacific market and the Latin American market. Obviously, over in Europe, they broke in, and now they're starting to do not as well, so I think they really are going to be focused more on that in the near future, and then perhaps later on down the pipeline there will be something, but nothing anytime soon.
From a valuation perspective, a PE of 15.5, growth rate was 6.2%. Would you see the PE more likely to expand or contract on the basis of that kind of sales growth rate?
You want to field that one?
Well, I think, I don't know the answer to this.
I would say that I would be more likely to see it contract just with the way Kellogg's is. I think their sales right now are just not being boosted enough to really get that PE up anymore. And let's face it, they're not a growth company. They're a big company, and they're doing what they're going to do. We don't predict them raising too much in the near future, and I don't think, with such a low beta, I don't think there's any delusions that Kellogg's is going to, be blowing up big anytime soon. Unless they reinvent the cereal, right? And they're trying, right, with the Kellogg's To Go and stuff like that. They're trying to kind of reinvent it in a more fast-paced world where people don't take that time to sit down and eat breakfast anymore. But short of a large innovation, say a breakfast that makes itself, perhaps, I don't think we're going to see that anytime soon.
What was their net income in 2013 or 2012, the most recent year?
Does anybody remember that?
For your valuation on a PE basis,
Right.
why didn't you forecast a future PE, given the fact that Project K is estimated to have cost savings of $400 million?
425 to 475.
That seems like that would be a big driver to
Right.
improvements in earnings going forward that might not be reflected in last year's earnings or
Right.
this year's earnings. But your valuation was based on this year's earnings estimate,
Right.
which seems to me is missing a big chunk of what people are
Right.
forecasting.
We know that historically, using historic figures is not a good way. Obviously, we want to predict the future. But as far as where we are academically, creating a pro forma balance sheet and a pro forma income statement and trying to predict the future was a little bit beyond the scope of I think, our capabilities at this point. We wish we would have done that. We just didn't have the skill set to do so. We are still learning how to do this. So with what we have learned so far, that's why we chose to do what we did.
In their talking to management, analyzing the company, and they got needs for acquisitions, reducing debt. What about their dividend payout policy? Is there it's, you know, in a time when investors are looking for income.
Right.
This could be an attractive, mature company that's stable, that can give a, do you see it maintaining the payout ratio or increasing, which means the dividend would increase over time with earnings?
I mean, historically, we're seeing that Kellogg's increasing their dividends per share year over year. So we expect to see that continue in the future because they have strong management and because of their cost initiatives to increase their margins. So we do think that they're going to continue to increase dividends per share.
Would you consider using a dividend discount model for your valuation?
We had played around with it, but we didn't like the figures that we were coming up with. So that's why we stuck with the price to sales and PE multiple and price to cash flow.